Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today on the show, we've got Earl Davis. He is the head of fixed income at BMO Global Asset Management. And it was a little bit of a disconcerting interview. I say that because he was optimistic. Now, I don't know if you know a lot about bond investors, but they're sort of the Eeyores of financial markets, always worried about what could happen and what could go wrong. And I won't say that he's 100% optimistic, but probably the most optimistic bond investor I've ever found. Let's find out why that is. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Earl Davis, thank you so much for joining me.
It's a pleasure. Thank you.
So as the head of fixed income at BMO Global Asset Management, you have to make a lot of big calls.
Yes.
You have to think about the macro. You can't put it in a box like maybe some of our stock jocks can. And it's so funny when you think about the macro. You know, you've been in this career for a long time, and I've been a journalist for a long time. And I feel like for a large chunk of my career, post-financial crisis, I was always talking years and years out. Okay, we're still dealing with the hangover of the financial crisis. Now we have another shock to obsess over, the pandemic. And I feel like we're still obsessing over the hangover effects of that. Tariffs are a part of it, but inflation is still kind of that thing that we're dealing with post-pandemic.
Yeah, that's correct. There's two things we're dealing with. One's inflation post-pandemic, and the trend, even though it hasn't been going higher over the past year, it's starting to go higher again. You know, we've come down from the peak, and it looks like we're going higher again. But I think the more persistent, important, lingering effect from the pandemic is deficits. Look at the amount of money governments are spending, and they feel comfortable spending more. And I think that's going to be with us for a while.
And those two are kind of linked, right?
Definitely linked, because what happens with deficits, when the government spends, they're actually printing dollars or taking money and putting it into the public coffers, and then we spend it. So the more money we have, guess what? The more money we spend. And that's going to keep inflation underpinned as well.
Let's talk about your high-level view on inflation, and I want to give you your flowers because I remember talking to you a couple of years ago, and you said, we're not going straight back down to a regular 2% life. And that's exactly what the markets were pricing in. Yes. We're going to go back to 2%, and everything's going to be just the way it was before the pandemic. And as I mentioned, it's now 5 years out, and we're still trying to get back to that point. Why, in your view, has inflation been so sticky? And how do you see it evolving from here?
Yeah, I'm going to answer this from a good news, good news perspective. Okay, so the bad news. The bad news is inflation's going higher. We've seen that. It's higher than the Bank of Canada's range. They're trying to target inflation in between, call it 1% and 3%. So 2% is that ideal. I have a sense it's going to go up to 4 to 5%. The good news about that, it's not going to go to where it was post-pandemic right away. You know,
like
where
7%.
7, 8, that is bad. You know, that's where it becomes a self-fulfilling prophecy.
I didn't like that you used the word right away.
Well, the thing is, we do have to get fiscal discipline at some point in time. It's not going to happen for at least 5 years. The reason why it won't happen for at least 5 years, everyone's still increasing their defense spending. That's going to be persistent. The other thing that's going to be persistent, and I won't go too much in the weeds, governments are feeling the impact of higher interest rates as well, because they have to pay a higher amount of interest. So the interest costs that governments have to pay on their deficits, plus defense spending, is going to keep deficits high, which will keep inflation higher for a while.
Let's go country by country, and we'll start with the U.S. because the U.S. is dealing with a lot of this, except that inflation has been undershooting expectations for the last 5 months in a row. And I wonder if inflation hunting is going to be like recession hunting, where we hunt for a recession for years in the US and it just never manifests. And, you know, now tariffs are in play. Why aren't we seeing that big surge in inflation?
Well, the reason why we're not seeing or haven't seen, let me change my word, haven't seen the big surge in inflation is rents. rents and have been coming down in the US. And that's a very big component of inflation and of the CPI. So with that coming down, it puts a lot of downward pressure on the number. So the headline number that we're seeing has been lower and undershooting expectations to what you just said. Having said that, yesterday we had CPI in both Canada and the US. And what we saw in that number, even though it didn't really shoot up, it still stayed elevated, is the beginning of tariff inflation coming through. And we're starting to see that in those numbers, and that could be persistent for a while. And to me, that's what's going to drive inflation from 3% to in between the 4 to 5% range. But it's not a bad thing. This is the key thing to remember about inflation. It actually doesn't really matter what inflation is. What matters is it has to be consistent within a range. If we don't know if inflation is going to be 1% or 7% next year, it's hard to invest as a business because you don't know what your costs are going to be. But if we know inflation is going to be 5% every year, boom, 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 we could invest in the business because we know, okay, the prices will go up next year, wages, the prices, we get more money. It's easier. What we haven't seen is consistency in inflation, and that's what the market needs to be comfortable.
I'm sorry, I still think 4 to 5% sucks. I'm still like getting my head around paying $25 for a salad, and I don't see a Federal Reserve that cuts rates.
Yeah.
Doesn't matter if inflation's consistently at 5%, and maybe they even need to increase rates.
Well, here's an important part that I didn't mention. Part of that inflation equation and 4 to 5% being all right, your wages increase by the level of inflation. So even though you're paying more next year for goods, you have more in your pocket. So that's one of the consistent returns. You just can't have that number being out of control. And that's the key thing,
How do you think about tariffs then? Like what is in that 5% number?
It's basically, there's a couple of things in that 5% number. The initial one is the price shock. We haven't seen it. And coming back to your own point, why haven't we seen it? Because people stacked up before the tariffs came up. They stacked up their inventories. They built them up. We're still experiencing the benefit of that, the tailwind. But it's around now and September when those inventories run out. And guess what? Companies have to buy the goods again, and then they'll be paying the tariffs, which they will have to pass through to consumers, and we will see it. So that's why we're going to get this tariff, but it's not going to go to 8-9% annually, but we could go to like that 4 or 5%, which is above what the central bank is comfortable with.
Yeah, you see the Fed cutting at least once this year.
Yeah, but not because they should cut.
You think because it's political pressure?
Oh, 100%. Like you see the employment number last in the U.S. That came out on July 3rd. Higher employment blew out expectation. Growth now is positive again. There's a lot of positive impacts in the economy that say, and tax cuts. We haven't even felt the what is it, BBB, Big Beautiful Bill?
Yes, yeah.
That is all stimulative. For all those reasons, you shouldn't be cutting. But there's pressure to cut. Why is there pressure to cut? There's two drivers of the pressure to cut from a political perspective. One is it keeps the economy going. And we all know, at least Trump 1.0 really liked the stock markets going higher. So cutting rates will help that go higher. But the other one, too, is what I mentioned before. The governments have to pay interest on their debt outstanding. If they cut interest rates, they pay less money out. There's more money in the government. So there's two drivers to have it lower, but the risk of doing that, so why aren't we lower is the question. The risk of doing that is inflation could really get out of control. So we have to keep an eye on that.
Is it a policy mistake?
No, it's too early to say because we don't know what the right level of interest rates is to say. I would say actually, I would err to it not being a policy mistake, but don't know yet. And the reason why I would err to it not being a policy mistake is that the interest rates have gone up. What did it go up? 500 basis points in the U.S. basically, from 0% up to 5% or 5.25. Now they're back to 4.25. So if you go to 4 or 3.75. You might still be in an all right zone. So I could understand the political
will.
will.
Like a cut for the vibes.
Yeah, but yes, it is. So it may not be a policy mistake, but in my mind, if the economy is going all right, you want to save that ability to cut for when the economy is not going all right.
So, this doesn't seem like a great situation, right? Where inflation is at 5%, interest rates will likely remain elevated. But to your point, maybe it keeps the party going a little bit longer. So how do you want to be invested? And we're going to talk specifics a little bit later, but like on a high level, are you inclined to fight this? or are you inclined to just lean in? It's not the best case situation, but it's going to be risk on. So I'm going where the risk is.
So it's an easy and difficult question to answer. So from the easy, I'll answer the easy and then I'll answer the difficult first. From an easy perspective, it pushes out recession risks. We don't foresee a recession in 2025 nor 2026 because when your interest rates are lower, it's easier for businesses to borrow. It's cheaper for them to borrow. They're more likely to hire, more likely to expand. That's a good thing for the economy. So to your question, I wouldn't. Would I lean into it? Would I really buy a lot of risk assets? And the answer to that is it depends. It depends on the price. So when, and I deal in bonds and we talk spreads. So when the markets are doing very well, spreads get tight. It means, lower interest rates. And when they don't, they widen.
Which basically means like the gap between how much you're paying for like a safe asset versus a more risky asset is narrow. You're not getting so much more of a premium for the risk.
Yeah, you're bang on. So let me expand on the word spread. It's called a corporate bond spread. So that's your spread over a government bond that you would pay for the risk. And the reason why you get that spread is because a government bond is default free. There's no defaults because a government could always print money and give you back your money for your bond. The value is a different question, but it's default free. Corporations don't have that value, so you want to get paid extra for that risk.
I'd love to drop kind of an argument that I see floating around out there, and a few guests have made the argument on the show, is that counterintuitively, tariffs are deflationary because they two reasons why. One is people pull back on their spending so businesses don't feel confident in raising their prices. And we do see signs of that in earnings. But then also you've got a president who's saying, I want you to eat this tariff, meaning don't increase prices, just sacrifice it in your margins. And so we're not going to see the full pass through.
So no, I would say in certain scenarios, they could be deflationary. I originally thought that as well. Now they're not. And I'll explain to you why not. Okay, let's explain why they're deflationary. A tariff is basically a tax. If you're paying a 20% tariff, that means you have 20% less money in your wallet to spend. So you spend less, the economy doesn't do it. There's one sort of offshoot to that, or one offset that has been triggered, basically. It's government spending. So the big, beautiful bill actually puts money in people's pockets into the economy that offsets the tariff impact for local domestics. We're seeing that in Canada as well. We don't know how yet, but we're seeing it through an increase in deficit. Defense is one of them. If we get infrastructure deals across Canada, what that is, it's money going from the government's pocket to the public pocket. That offsets the impacts of tariffs. It's no longer deflationary. So if the governments weren't increasing the amount of money in the economy by deficit spending or actually printing dollars, then yes, it is deflationary. And so now the pie is getting bigger. So you can pay more in tariffs. Before, without that spending, the pie doesn't get bigger. So if tariffs take up more of the pie, there's less for people. That's deflationary, but we're no longer in that environment.
So base case, no recession in the U.S. We shouldn't cut, but there probably will be just one cut, and inflation going back up to around 4-5%.
Yes.
Now, I want to throw in another wild card, which is a new Fed president at some point in 2026. So we remove ourselves from the Jerome Powell playbook. And based on headlines and Donald Trump's own words, he's looking for a dove. He's looking for someone who's going to cut rates. Does that make you question whether or not, we're going to get more rate cuts than you have initially baked in? Or do you think no matter who's in, even if they're dovish, if you're seeing a 5% inflation print, they just can't cut without risking a big crisis?
Yes, I would get more wary of inflation. It possibly could go higher if a very dovish Fed governor comes in, because we have that playbook already. That was the Nixon era. That was the 70s. And that's when inflation went to 10% or the like. We're not there yet. As a person who deals with money, deals with that, I like dealing with things once they come up. You speak about it and you're prepared. Right now, that's not the scenario we're in, but it's a very possible and plausible scenario if we do get a dovish Fed governor.
Because that would be bad for markets, if I recall that Nixon era.
ultimately bad for markets.
Yeah. But you're not willing to go there. You just know what could happen.
No, everything has a sequence and a path. So before it's bad, it's actually good for markets. Because when the central bank starts easing, there's a euphoria. It's almost like an adrenaline shot. The adrenaline doesn't last, but you know it's going to be there. So if you go ahead of that or try to get ahead of that, you will get run over by the adrenaline shot. So that's why I said we deal with things as they come. We anticipate that. We know there's a sequencing. So before it gets bad, it will get better. And there's money to be made off of that on both sides.
So I hear from you as like, stay nimble, like ride the wave while it's here, stay nimble. There was also a thought earlier this year that the bond markets, I don't think there's a more formidable foe out there than bond investors, right? War is one thing and bond vigilantes are another. And often bond vigilantes win, almost always they win. And this is basically a point where bond investors say, that's enough with the deficit spending. I'm going to charge you way more to own your debt. We saw that in the UK, and that's how Liz Truss had that very short tenure. And there was a moment in 2025 where we thought, ooh, are they coming for the U.S.? What do you think the red line is for bond investors?
So the red line is deficit, without a doubt. You're there. The question, I actually think the bond investors have been pushed out a while. The bond vigilantes have been pushed out for a little bit. They may come back in 2026 for a bit. And the reason why I think they've been pushed out for a little bit, what we heard from the Treasury last week was a surprise surplus in their revenues, all related to tariffs. Yeah. That is a benefit of tariffs from a domestic or local economies, that you get more money in. So what does that mean? If they're getting more money because of tariffs, let's say that your rate's set at 20% globally, that's a lot of income coming into the US. You know what that means? They don't have to issue as many bonds. Ultimately comes down to supply. Yes, exactly. It ultimately comes down to supply demand. I think supply will come down before it goes up, because the tariff revenues haven't been incorporated in the budget. How could you? We don't know exactly what they were, whether it be in Canada or US or whatever. But there will be money that comes into the coffers because of that.
That is a good point. And I clocked that there was that surplus and it was tariffs. And what I didn't know, and maybe I can ask you, is like, how do you model that out? Like, do you expect that to be one-off? Do you expect that to be volatile? And how much does it paper over the deficit?
So we look at it and we anticipate like a baseline, if you call it 20%, and then you just look at the revenues, imports, exports, the numbers that came out last week, and you can model that out easily. Here's the interesting thing about trading markets, especially bond markets. There's a lot of different things that could impact the market. There's, as you said, supply, there's inflation, there's deficits, there's geopolitical, there's a lot of different things. So let's say that's just 4 things I named off. The bond market at any point in time right now only trades off one thing.
Yeah.
So you have to be aware of the other things, but you especially have to be aware of what the market is trading.
And now it's trading on?
Oh, you know what? Now it's trading, I believe, even though people might not say this, I believe it's trading off of Japan.
Yes. Okay. Take us there. We haven't spent a lot of time on the show, so you might have to do the ABCs of what's going on.
So Japanese bond investors are the biggest bond investors in the world. And the reason why they're the biggest international bond investors, their interest rates have been so low for so long, 0%. So to make they have to go elsewhere. Right now, they're experiencing spikes higher in their interest rates. And they just recently, over the past week, I think their 30-year bonds, 25 basis points higher. That was the trigger for us going higher. So why is it higher? Politics, of course. There was a poll that came out that said the opposition is starting to lead now in regards to coming over to take in the government. They're less fiscally disciplined. They will spend more. So people are getting scared of that because bond debt is the largest in the world. So what happens when they spend more is that those interest rates go higher. So how does that impact all the other markets? If those interest rates, instead of 0% or 4%, right now they're at 3.25%, local investors saying, "Oh, give me those bonds."
Home. Yeah, they come home. Yeah,
and that's less money elsewhere, less demand for bonds, which means it has to go higher to attract a new buyer in. So that's what the market is trading on now.
Bond markets. It's like all these obvious things, and then it's like, just kidding, you have to bone up on Japan.
Yeah, exactly.
For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, 88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, so that's a good lay of land of the U.S. and Japan. We have to obviously talk about Canada because, we're attached at the hip to the U.S., we've got our own situation here. It's not supposed to be a great economy, but then this month, I should say, all of a sudden we're adding 83,000 jobs to the economy. Inflation is at a level that is inconsistent with the Bank of Canada cutting rates, at least in the next couple of weeks.
That is correct on all those fronts. So Canada, actually, I'm against the trend a little bit. I'm optimistic on Canada, especially in the short and medium term. Longer term, I'm not as optimistic, and we could touch on all. The number one reason why I'm optimistic on Canada is we are inherently a commodity-based economy. If you saw the last international trade numbers, we're having record sales of aluminum to Italy, oil to Singapore, Japan, natural gas. Like, it's incredible the demand for our commodities here, and that's underpinning a good economy here. The second reason I'm optimistic is because I do believe the U.S. will be resilient, as we've spoken about. One of the things I didn't touch upon is there's a lot of deregulation in the U.S., which takes away the cost for small and medium-sized businesses so they could spend more, and those are the drivers of the economy. But because I'm optimistic on the U.S., 68% of our trade, it's less than the 85% it was 20 years ago, but still 68% of our trade is with the U.S., even with the tariffs. So if they're doing better, we'll do better. And then you bring in the intra-provincial trade deals or getting the barriers down. There's a lot of things to be optimistic about in Canada in the short and medium term. The reason why I'm not as optimistic long-term is productivity. As long as companies don't understand the economics or tariffs or the impacts, we saw this with Toyota and whether they expand or not in Canada, they will not put the billions of dollars you need to get productivity lower and to juice the economy beyond housing.
Especially the U.S. is making it hard, right?
Yes.
The U.S. is saying build here and you won't get tariffed.
Yes.
Like, that's a huge incentive. What's our counterbalance to that?
Our counterbalance, I go back to the commodity base. What now? What if we increase our refining, increase our, from the Atlantic to the Pacific and get things out both ways in regards to shipping goods. So I do think we have the base to be a very strong economy. We just got to make the right moves.
So how does that show up in growth? Do you think growth could surprise to the upside this year?
Yes, but we have
a lot of people are baking in a recession.
I very much think they could surprise the upside. And we've been prepared for that, and bonds were actually lower weight of duration. So because when growth surprises to the upside, what happens is your central banks are less likely to ease, even though we believe it's 25 to 50 basis points. Up until last week, that was 50 to 75 basis points. That's even coming lower, right?
Yeah.
So less likely, which means your bond yields could go higher. But that's supported if you have good growth.
And duration means, in very simple terms, your exposure to interest rate changes.
Yeah, even more simple than that. It means what's your maturity for the bond? Am I buying a 1 or 2 year bond or a 10-year bond? So duration, the longer duration is the longer bond you buy, 10 years. There's more price risk, more volatility the longer bond you buy.
One thing that's a black box is the state of our federal finances. And we don't know what that is, but based on all the promises, you can add that up and it seems like we are going to be in for a large deficit. How do you think about that? I mean, is that ultimately stimulative?
Two things. Yes, it is stimulative, but out of all the developed nations, we are in the position to do it. I know it's a shock number when you get a large increase in deficits and it's not sustainable, but we're in the best condition fiscally and financially, surprisingly, probably to a lot of listeners, when you compare us to the US, to France, to Japan. So as a comparator, people will still want to come to Canada. We have the ability to raise our deficits. Where I become concerned is at what level, because we're AAA rated by the rating agencies globally, one of the few left AAA rated countries. At what level do the rating agencies get concerned about the level of deficits here. We do have room, but they also have to show some fiscal discipline. That's why I'm not surprised that in the public market, what you're hearing now about the government is cutting employment, cutting government jobs to try to offset this. To me, a portion of that is driven by trying to keep our AAA rating and to show the rating agencies that, yes, we're increasing defense, but we're doing stuff on the other side. So I think we're in a good position to increase deficits, surprisingly, but which puts us in good hands from a future growth perspective.
I mean, if there's anybody better poised to think about that, it's Mark Carney, who spent time as the Bank of England and Bank of Canada governor. Can you see that experience and that training showing up in some of the policy decisions he's making?
Oh, 100%. And I think the other thing that shows up in the policy decisions that he's making, he made this comparison as well, Churchill. Churchill was the wartime prime minister in England, but he was a one-term prime minister. He made decisions specifically related to the war and the best things. I think because Carney, although he was a public servant before, he wasn't a politician, doesn't have that desire to be a lifelong politician, will make harder decisions without thinking about getting reelected. And I think that's a good thing to be in, good position to be in.
For the country.
For the country. Yeah.
One thing we haven't touched on yet is how does this all play out with respect to inflation?
Yeah. As I said, inflation will go higher, which and above the Bank of Canada range. I see inflation 4 to 5%. The Bank of Canada range is 1 to 3%. Having said that, I personally feel in 5 years' time, the Bank of Canada range and the central bank's range will be 3 to 5%. They have the ability to change it every 5 years.
You think they're going to move their target to?
I think not this year or next year, but 5 years from now, I have no doubt about it, because then people get used to the inflation, get used to paying. Like the shock.
I don't think I'll ever get used to paying $25 for my salad.
Yes,
but maybe that's just me becoming an old person.
No, I hear you. And I bought a croissant coming in, and I'm like $6 plus 25% tip. What is this? So I hear you, but we do become used to it.
It's interesting when you talk about the areas of strength in the economy, that once again, it's kind of commodities, and we're talking about it because for so long, we sort of built our strength literally on housing. And that seems to be wobbling in a number of markets. And this is the favorite punching bag. If anybody looks to Canada and says, this is where your accident's going to be, it's going to be in the housing market. Too many indebted people. And in terms of how much leverage we take on to buy these homes and the value of these homes. And now, as I said, like the Toronto condo market, you're seeing big wobbles. How do you think about housing as a headwind to Canada's economy, especially if rates are going to stay higher?
Let me take a contrarian view. I actually see it as a tailwind. The reason why I see it as a tailwind, that's the only reason why the Bank of Canada will ease. To try to, even though it's not part of their mandate, they want to try to support that part of the economy because it's such a significant part. So I see it as a tailwind because the Bank of Canada eases. That's like the tide rising, and everything improves because of that. Housing, yes, we do have issues here and things have to change. We are starting to see the housing, we saw it this morning in regards to housing starts picking up. So I do think that will change. I do think, maybe next year is the worst year, as the hangover of inventory in condos gets chewed up. But I do see that. In
terms of what? Like what kind of price declines?
Well, it won't be price declines in housing that people own or condos that people own. I think it's going to be relatively stable. Where we will see price declines is in the new inventory. And the reason why we'll see price declines there, if you've bought a condo before, when you buy a pre-built condo, you're paying 25% higher than market. We just never reach those prices, and the condo builders don't want to lower it.
Right.
So it'll come down to where we are now. Maybe there's a 5% at most. I'm starting to get constructive. I used to own real estate as an personal investment. Used to have a number of places. Now I have zero. But my wife and I are now planning on having the pool to buy investment properties next year.
Because those prices are coming down.
We anticipate next year could be the low, right? This or next year, yeah.
Well, either on a personal level or in your capacity at BMO, what's the immigration component for you? Because immigration was such a big boon to housing. Now we're pulling back on those levels. Though I talk to builders all the time who said, I don't need immigration. Like I can, there's enough domestic demand. But obviously with the wobble that we're seeing, clearly immigration was a big factor.
So yes, it was. I like answering yes, no. But the reason why it was a big factor is a lot of that immigration was student immigration. The students rented houses, they rented places, which made investing in condos or rental properties better. So when they came out, there's no longer that rent pressure, and we're seeing that rents are going down. But there's still buying pressure. It's like immigration's not zero, and the ones like the professional immigrants who had careers and professions who come here and come here with some money are still coming. So it won't have an impact on housing per se or the existing condos, but it will have it on that's part of the overhang as well too, why people aren't buying pre-built or newer condos.
So overall, to summarize, you're optimistic relatively on the US. You're optimistic on Canada. Maybe we avoid a recession. I need to check. Are you a bond investor? Because I don't think I've seen. I don't know very many optimistic bond investors.
Yeah, you know what? It's funny. I'm laughing because I think as a bond, you're totally right. The sky is falling is what bond investors are, and I've been a bond investor since 1994, and the sky is falling type of guy. I can't remember being this constructive.
Jeff Gundlach. Has Jeff Gundlach ever said anything positive?
And I think this is arguably the first time I've been this optimistic, but I am. I think we're adjusting to the inflation level. I think there's a lot of good stuff going on in the economy. Defense spending is good. The commodity base is good. U.S. with deregulatory thrusts is good. So I'm optimistic, which I'll give you the bearish side of that. It does mean higher bond yields. We're not going to get that flight to quality because people own bonds for two reasons. One is a flight to quality, which means when, a geopolitical risk or what we saw in the Middle East, your yields go down right away. So you want to have something that offsets when risk asset prices go down. You want prices go up, and they do in bonds. The other reason why you own them is the coupon. The interest and the corporate bonds. That's why we don't mind corporates, but it has to be select corporates at good levels because we don't see default or recession risks increasing. So we are optimistic overall.
All right. Well, let's see how we're going to put it into practice and get into your pro picks.
Yes.
Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, we're back with Earl Davis of BMO Global Asset Management. We're talking his pro picks, his best ideas, and you mentioned you like corporate bonds here. Let's talk about the specific issues that you like. The first one is the Fairfax bond going out to 2034. What do you like there? It's a 4.7% coupon.
Yeah, what I like there, Fairfax, they've actually been upgraded 3 times in the past 3 years. And part of that reason is they have such an acute focus on operational excellence. And to be in the property and casualty insurance business, you have to have that. So their premiums, their gross premiums every year is $32 billion. So what that allows them to do is withstand a number of disasters across the year. It's a very well-run company that can support their spread. So their spread, for example, on a 10-year bond, so let's call it a 9-year, 2034 maturity, is 115 basis points higher than the government bond. So you're able to buy their 10-year bond and get 4.70% coupon interest. I mentioned how important coupons are, which is above the level of inflation, which means you'll always make what they call a real return to be able to buy more stuff, not less, when it matures. So we really like that one.
It's interesting you talked about it being upgraded 3 times. How important is that criteria? Buying bonds that you think like the credit quality is going to improve. When you talk about upgrades, it's not like an analyst upgrading. It's these rating agencies that decide, are you AAA, are you BB, whatever.
So it's very important. So it's very important because it just means you're still going to get the coupon. You're still going to get your bond maturity. The biggest risk with a corporate bond is default. If they default, you don't get back your money. So that's the biggest risk. So why that's important, it's reflective of either one of 2 things, and this is both, a good company, a very good company, and good operating model, or a good sector to be in. And they're at the point where they're very well capitalized and great company and could be opportunistic on their purchases.
So kind of a lower risk way to get a bit more torque in corporates. And I would imagine your second idea, Enbridge, at 3.1% and goes out to 2033. Is similar idea, maybe even more of a safer play?
Yes, a very similar idea, slightly safer play because it's a lower maturity bond. As we spoke about the importance of maturities, you get back your money sooner. Globally diversified company, a majority 50% plus in both companies' revenues come from North America, but they are globally diversified. Very well regarded, just had record profits. So we like that, especially with our view of Canada and what's going to happen with the infrastructure expanding and just the growth in commodities. We think they're a very well-placed company to be able to support their coupons.
But you did bring one spicier pick,
Yes,
I like
yes,
that.
yes.
So this is a high yield play. Talk to me first before we get into it. Top Aces is it and a 9% coupon. Like, what is your approach, or what's the guiding light, golden rules of high yield investing?
Yeah, so there's basically two types of bonds, let's call it. There's investment grade, what we just spoke about, very well-regarded companies, safe companies, long-term holds. And then there's high yield. So what makes a bond high yield? It's either one of two things. They're either in a declining industry, something that's not doing well. And why that's bad is that means the company will make less money, less ability to support the bond payments, coupon payments. The other thing, so we just spoke about the industry or sector they're in, can put them in high yield. The other thing is the amount of debt they have. They may have much more higher than average or your investment grade debt, which again puts stress on the payment or future payment in case uncertainties happen. So what we look for in that case is something that's in an industry that is growing, where their revenues could grow and support the debt going forward, which makes us feel comfortable with owning in a high yield. But it's exactly that. You get a higher yield on that bond, which is very nice to add to your coupon income.
So Top Aces, tell me about that and which bucket it fits
Yeah. No, Top Aces is a very interesting company. It's a Canadian company. They just had their first bond issuance in March, came out at 9%, which is basically 550 basis points over the 5-year government Canada bond, more than double the pickup.
Yeah.
But what they do, they specialize in simulation, flight simulation, fighter jet simulation. They're the only company in the world that uses like F-18s and has virtual fighter jets. So with the defense industry spending, they actually train fighter pilots cheaper than local armies. So they're based in Canada, US, and Germany. Very attractive company with the fundamentals supporting their ability to withstand debt payments.
Well, that's what I was going to ask. Like when it's a new issue like that, like what kind of homework are you doing to make sure they can do that?
You got to do a lot of homework. So the homework is not only looking at the financials, which you could get through rating agencies and all that, but speaking to management.
You do that as bond investors.
Yes.
Yeah.
We have a credit analyst, dedicated credit analyst as part of our team. And they go out and they speak to the management, ask the questions beyond what you get by just looking at the financial statements of the industry and just you literally have to kick the tires.
All right. Yeah. Earl, thank you so much. What a pleasure to be with you.
Oh, it's always a pleasure.
That's Earl Davis joining us from BMO Global Asset Management. Make sure you tune into our next show. We've got JF Tardif on the show of Temello, and he's talking those small cap resource stocks, some of the higher risk plays, but certainly they can also be high reward. So if you've got a question about this sector, you can email us questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.